US CPI has almost put the 50 basis point cut on the 18th of September by the Federal Reserve off the table. Annual CPI year on year came in as expected at 2.5%, down from 2.9%. This would be a big headline win for the US Federal Reserve. However, core CPI, which excludes volatile data such as automobiles and energy prices, actually came in higher at 0.3%, above the previous month's 0.2%. So just to put that into a little bit of perspective, that is 2 months of growth on core CPI, which is a more accurate gauge of inflation. Now, the Fed are really trying to balance the scales between the labour market and inflation at the moment. Like most central banks, they don't really want to cut interest rates while inflation remains sticky or higher. Why? Because cutting rates can lead to consumers borrowing more, right? So if consumers borrow more and then they spend more in the economy, then it can lead to growth. And then when you have a period of unsustained growth, that can lead to inflation. And if we have growth, it can lead to job growth, for instance. Now, they don't necessarily want to see job growth, but they don't want to see it sort of fall either. And currently, the unemployment rate came down to 4.2% after the recent payrolls data on Friday. Now, for me, anything below 5% is considered healthy in an economy. Anything above 5% would be a considerable problem. Historically, over 5%. We've seen some recessions, so they don't really want to see that. So it's a very fine line they have to try and balance here. Now, looking at the CME Fed Watch Tool, the pricing now suggests that we are more likely to see a cut of 25 basis points. So what does all this really mean? Well, if we take a look at the US dollar reaction, it's in a very precarious position for one, with the dollar index just holding above the 101 handle, the key support that we've seen in the recent past. But if the market feels that 25 basis point cut is still too restrictive, we could actually see dollar decline further here and continue its path that what we've already kind of seen. It can be tricky to identify what's going on from just this alone. So if we take a look at what the big players are doing at the moment, we're actually seeing a substantial level of buying coming in from the non-commercials. And non-commercials are large speculators, those that are in the markets to make money. Now, you can take a look at this in sort of one or two ways. That means they're either hedging their positions, so they're increasing longs because they're heavily short and they're increasing those long positions, or they feel that there is a turning point coming in the US dollar very, very soon. So that's something that you should consider going forward. Non-coms heavily getting long at these types of levels. Now, typically when they get extreme longs going, that can be pretty bad for price. So I'm interested to see where the US dollar plays out from here. It's going to be very tricky to divulge where that's going to be. What we can take a look at is how the recent performance of the US dollar has been. It's been fairly poor. So unless we get some substantial changes in conditions here, I still feel like the dollar short could be something to experience in the very, very near term. Thanks for watching the video update. I hope you enjoyed it. If you did, leave this video a thumbs up, subscribe if you are new, and I'll speak to you in the next video.